What's happening, everybody? It's your boy Kreative. Go ahead, say it with me. We are back at it again to do what? To create something great. Now, today I'm super excited what I have planned for y'all. We're going to be talking about slippage, a topic that is not mostly covered, but will eat away at your cost if you're not paying attention to this. So today we're going to be talking about it with respect to options, right? And what is an option? An option gives us the right, but not the obligation in order to buy or sell 100 shares of a underlying stock, right? And we're going to be talking about stocks, right? And stock is you have equity, you have ownership of that particular company, right? So if you haven't already, go ahead and smash that like and subscribe button. So let's go ahead and jump into this. Now I'm going to be breaking this up into lessons, and each lesson is going to be followed through with some checking for understanding, because I want to make sure that y'all are following, y'all picking up what I'm putting down, right? So go ahead and put your answers to the quizzes in the comments, and let's jump on into this. So let's go to lesson one, and lesson one is going to cover what is slippage. So our word bank that we need to understand, in our terms we need to know, is slippage is the difference between the price that we wanted, right? And this is the price that you actually got, right? So being able to understand this, I think, would just set you up for the entire lesson or the entire video. So what is slippage? Slippage is the difference between the price that you wanted and the price that you got, right? So this is when you submitted the order, and this is when you actually got the order filled, right? And the bid price is the highest price somebody's willing to pay to buy from you right now, right? And the ask price is the lowest price somebody will sell to you right now. So think about it this way. If you want to get into the market, right, you're going to ask to get into the market. If you're going to ask to get into the market, you're going to be paying the ask price, right? And you want to get the lowest price possible. And if you want to get out of the market, right, so you want somebody to buy it from you right now, you want to get the highest possible price, right? So that is the difference between the bid and the ask, just super simple. And the spread is the gap between the bid and the ask. This is the market's fee just for trading. I think the market's fee or tax is the slippage too, but hey, more on that later. So slippage is the difference between the price that you expected when you submitted the order and the price that you actually got when the order filled. It's like ordering a pizza for $10 but actually paying $10.50 when it arrives. That extra 50 cents, that's slippage. So slippage is the tax the market charges us just for trading, fam. So every trade has two prices. It's going to be the bid. This is the price that if you want to get out of the market, you're going to be paying the bid price, right? This is what buyers will pay you right now. And if you want to get into the market, right, you're going to ask to get into the market. And if you ask to get into the market, you're going to be getting the ask price. And the gap between the two, or the difference between the two, is called the spread. The spread is where the slippage comes from. So real example of being able to understand it. So SPY is the S&P 500. This is the top 500 companies within the New York Stock Exchange. Our bid price, this is the price if you want to get out of the market, is 681.86, right? You sell it here, right? And our ask price, if you want to get into the market, we buy here, is going to be 681.87. So the spread is 1 cent, right? So super tight spreads, right? The tighter the spread, the easier it is for you to get in and out of the market. The wider the spread, the harder it is to get in and out of the market. And you'll see some examples here. Mid price, and even though I'm going to mention it, it's kind of dangerous to use it, but mid price is going to be that fair price, right? You can submit a limit order on the mid price, but are you going to get it filled? Probably not. So just stick to your bid and your ask, right? Your bid, if you want to get out of the market, you're going to sell it here. Your ask, if you want to get into the market, you're going to buy here. So slippage math, if you buy 100 shares of SPY, you see the price of 681.87, the last trade, but you actually pay 681.87, the ask, right? So the slippage is 0.00 for 100 shares. 0.50 lost to slippage, right? Really nothing lost to slippage. So this math is incorrect. My fault, y'all. So we really didn't lose anything to slippage, right? Maybe a cent to slippage, because as you can see, super tight spreads. So the price that you see is not always what the price that you get. So the price that you submitted the order is not always the price that is going to be filled. I think the music is a little bit too loud. Let me just turn that down a bit. All right, beautiful. Let's keep going. All right, let's go ahead and jump into our quiz. So what is slippage? Slippage is going to be the profit that you made on a trade, bruv. I wish. The difference between the expected price when you submit the order and the actual fill price, the price that you actually got. That sounds familiar. The commission your broker charges. That's something completely different. So just by process of elimination, we're able to understand it, that why slippage is the gap between what you expect when you submitted and what you actually paid when it filled. This is the hidden cost. So you want to buy a stock. What is the price? What price do you pay? The bid? Probably not, right? Because when you bid, you want to get out of the market. You want somebody to buy it from you. So that doesn't sound right. So you want it to, when you want to get into the market, you want to pay the ask price, right? So because you're asking to get into the market, if you want to buy a stock, the last traded price, I wouldn't be mad at that either, but it is going to be the ask. So buyers pay the ask price, sellers pay the bid price, right? The spread is the, between them is where the slippage lives. SPY bid is 600. The ask is 610. What is the spread, right? So difference between the bid 600 minus 610 is the 10 cents, right? So just by doing our math, we're able to deduce that it is the 10 cents. Beautiful. Let's go ahead and jump into our next lesson. And our next lesson is going to cover the types of slippage. So we have a market order. This is a buy or sell right now for whatever the price is available. This is fast but risky. Now, I normally use market orders as like a fallback just in case my limit order doesn't go through, because normally for our algo bots, right, we are submitting limit orders. And I think I'm going to create a video just by breaking down what is an algorithmic trading bot. But for right now, let's just stick on slippage, right? So a limit order is a buy or sell only at the price or better, at your price or better, safer, but you may not fill, right? And fill is when your order actually executes and you own the stock or option. A partial fill is only some of your order went through and the rest is still waiting. So 3 types, not all slippage is the same. Understanding the different types helps you choose the right order type and avoid paying unnecessary cost. So type 1 is the slippage spread. This is the most common. You pay spread every time you use a market order, right? The reason you want to use a market order, sometimes you see an opportunity, you want to jump into it right away instead of paying a limit order, the price that your price, what you want, right? Or a better price, you want to jump into the market right now. I want to say 60. Okay, that's kind of high. 60% pan traders are going to use market orders, right? Not everybody's going to submit a limit order, right? Because you have to wait, right? You have to wait in order to get your price or better, right? It is safer, but you may not get it filled, right? Normally you're going to use market orders. I don't, right? Limit orders is where we live. Only a market order on extreme occasions. That's when I want to get out, not to get in. Because why am I going to overpay, right? Because sometimes when you use a market order, you're definitely, I'm going to say definitely, but majority of the time you are going to overpay or undersell. So an example, mid price is 100. You buy at X 105. Your slippage is 0.05 per share. This is predictable and unavoidable with market orders. So type 2 is going to be side slippage. This is going to be big orders. When your order is bigger than the available liquidity, right? So how much do we have for the market in order to buy or sell? So your ask is, and you want to get into the market, so you're going to pay the ask price is $100.05 for 500 shares. You want to buy 2,000 shares. That's wild, fam. So the first one is going to fill, but there's only 500 available, right? So the first one is going to fill. Like, all right, bet. And you have to batch the next first 500 fill. So you have to batch the next 15 in order to get your 2,000 shares, fam. So big orders equals worst average fill price. And then we're going to have type 3, which is going to be the volatility slippage, fast markets. And this is sometimes you can't help it. Like sometimes it just happens, right? So the price moves while the order is being filled. Example, you click to buy at 100. News hits, the price jumps, you get filled at 150, right? That 50 cents is going to be the 50 cents per share. News happened. Was it big news? Okay, we have an update. I'll do that after. And normally we're getting these updates like every so frequent. I feel like it's like 4 to 5 updates cursor is dropping a week. I mean, I get it. You want to be able to improve it, but like, bro. All right, let's keep going. I'm not going to go off on a tangent there. So we have news, and that news could be earnings. That news could be somebody just got fired, somebody just got hired, a new R&D, new drug just got approved, right? Whatever that news is, it could be Fed days or the market just opened. So these are the different volatility. It might be CPI, sometimes it could be PPI. So it could be different types of events that'll happen that'll impact the volatility when it comes to a fast-moving market. So the order types is going to be a market order, guaranteed fill, but you pay the spread, maximum spread risk. A limit order is you set the price, but it may not fill. Minimum slippage risk, and then a stop order is becomes a market order when triggered. High slippage during fast-moving markets. Which order type has the most slippage risk, right? Remember just a little peek up. Right? So if we're just going to look, we're going to see that it is market order. Why? Market orders fill immediately at whatever price is available. Like you want to get into it now because you see that opportunity, right? But if you get into it now, what are you going to be paying? That slippage. So limit orders only fill at your price or better. You need to buy 10,000 shares, but only 2,000 are available at the ask. What happens? Your order gets canceled. That's a mean broker. You get partial filled, then you have to wait. Your price, you pay a higher price as your order walks up the book. Walks up the book. That's an interesting new one. You're going to get a partial fill, fam. Then you're going to have to wait for the remaining 8,000 shares once it becomes available. Why large orders? My answer is C. That's interesting. Why large orders eat up through the order book, filling it at progressively worse prices. This is the size risk. Interesting. So volatility slippage. When is volatility slippage the worst? During lunch hour when the market is quiet. The market is not that quiet during lunch hour, right? You're going to see a lot of market dropping during lunch. Like right now, market is kind of like on a little sell off right now during lunch hour. So I'm not going to consider that to be quiet. During Fed announcements or market open, or after the market closes. So we're going to drop it in at B. Beautiful. Let's go ahead and jump into our next lesson. Next lesson is going to be measuring slippage. So our word bank is going to be the expected fill, the price you thought you get when you click buy or sell, the actual fill, the actual price what you got. So when you submitted the order, when the order actually got filled, often worse than expected. Sometimes it could be better. The slippage percentage is going to be spread as the percent of the price. Higher the percentage, the more the slippage cost. And the mid price is going to be the halfway between the bid when you want to get out the market, the ask when you want to get into the market. This is normally considered the fair price, but you rarely get it. So the math, you can't manage what you can't measure. Learning to calculate slippage helps you understand your true trading cost. Memory trick, slippage percentage equals the spread, right? What is the spread? The spread is the difference between the bid and the ask. And what is the bid? The bid is the when you want to get out the market. What is the ask? If the ask is when you want to get into the market. And what is that mid price? That mid price is sometimes considered our fair price, right? Multiplied by 100. That is what the slippage percentage is. All right, so slippage per share equals the fail price minus the mid price. So slippage percentage equals the ask, subtract the bid, and that's going to be the spread, divided by the mid price, which is going to be the fair price, multiplied by 100. Round trip cost is going to be the spread multiplied by the shares. You pay half the spread at entry and the other at exit. So live look at it. We're looking at QQQ. Remember, excuse me. Okay, my fault. We're looking at SPY. SPY is the S&P 500, the top 500 companies within the New York Stock Exchange. The bid price, if you want to get out of the contract, we're looking at $679.43. Our ask price, if we want to get in to SPY, we're looking at 679.44. Our spread is going to be just a penny, right? So our spread percentage is going to be 0.01%, right? Super, super tight, right? So it's easier to get in and out. So this is one of the most liquid assets to be able to trade in the world, right? Because you have over 40 million, I think, on average that is traded for SPY. I mean, there's some days that are higher, some days that are lower, but on average, you're looking at 40 million people that are trading SPY consistently, right? Top 500 companies. So it's an ETF. And then we have QQQ. QQQ is the top 100 company, top 100 tech companies within the NASDAQ. So QQQ allows us to be able to gauge how the tech sector is doing, right? So 597 if you want to get out the market, 597.52 if you want to get into the market, right? So our spread still that 1 penny, right? Still super, super tight. IWM is the Russell 2000. Russell 2000 is going to be the top 2000 small cap companies, right? So these are companies that are up and coming, companies between, I believe, 200 million and just under $1 billion. And some people, that's small cap. Yeah, bro. You have companies that are worth trillions of dollars. So yeah, that is small cap, fam. So if you want to get out of the market, it's 261.41. If you want to get into the market, it's 261.43. We have a spread of 2 pennies, right? And here's our percentage, right? So a little bit wider, right? So a little bit harder to get in and out of it. Then we have Apple. Everybody know who Apple is. So I don't need to explain that. To get into Apple is 261.55. To get out of Apple is 261.61. So we have the higher spread. This is our stock. Each one of these are ETFs, right? So our stocks, you're going to see a little bit higher spread and higher percentage as well. A lower spread percentage equals is cheaper to trade. QQQ and SPY are super liquid, so are super cheap to trade. Less popular stocks cost more in slippage. So you trade 100 shares of a stock with a bid of $99.95, right? If you want to get out of the market. If you want to get in the market, it's $100.05. So that slippage is 10 cents. Our mid price, our fair value price is $100, but we rarely get it. So our spread is going to be 10 cents, or the spread percentage is going to be 0.1%, right? Entry, if you want to get in, you're going to pay the what? The X. Right, so it's going to be, to buy 100 shares, we're going to pay the 100.05 minus the 100, right, times the 100, and $5 just in slippage if you want to get in, and then $5 to get out. So total round trip was $10 just to trade this particular contract here, this stock, right? So that's crazy. So you got to be able to understand that slippage isn't everywhere. So to understand how it works and where your profits are going is one way to be able to make sure that you're staying ahead of the game. So let's go to our quiz. Let's see if we can get a 3 out of 3 this time. So bid is $50. Ask, and bid is if you want to get out the market. Ask is 50-10, right? If you want to get into the market. What is the spread percentage, right? So the spread is going to be the 50 minus the 50-10, so it's 10 cents. So spread percentage divided that by 100, so we're going to have 0.1. So our answer is going to be, wait, make sure I type that right. Bruv. Oh yes, I did it. Okay, so we have the spread, which is 10 cents. The mid, I should just brought out the calculator. I was trying to do this in my head. My fault. Mid is 50.05. So the spread percentage is going to be the spread divided by the mid, right, times 100, which is going to be the 0.2. I should have brought out the calculator, which I'm going to do. You buy 500 shares, and then later you sell them. How many times do you pay slippage? Once. Entry only. That's, I wish. You're going to pay it twice, right? You're going to pay it on the entry and on the exit. Why? Round trip equals 2. You pay spread on the buy and to sell. That is why slippage adds up fast. So a stock has a 0.5% spread. You make 200 round trip. That's crazy. 200 round trip trades. How much is slippage, right? So 0.5 spread, you make 200 round trip trades. How much is slippage? 0.5 total, 50% of your capital or 100% of your capital. So I'm not going to, this sounds outrageous, right? 50% and 100%. So just by process of elimination, bam, 100%. 0.5% times 200 trades equals 100%. High frequency trading without tight spreads destroys your account. Definitely true, fam. So lesson 4, option slippage traps, right? Word bank that we need to be able to understand is liquidity. Is how easy is it to buy and sell without moving the price. More equals better. Volume is going to be how many shares / contracts traded today. High volume equals easier fills. Open interest is going to be the total contracts that exist. Options, higher equals more liquid. What is more liquid? It means we can be able to get in and out of that contract super easy. And bid and ask size is how many shares contracts are available at that price. So options have wider spreads than stocks. The further out of the money you go, the worse it gets. This is where traders lose a fortune. Memory trick, cheap options aren't cheap when you factor in the spread. So why option spreads are wider? Less liquidity than stocks, more risks for market makers, hundreds of strikes equals fragmented volume. 0 DTE options have very few traders. So real option spreads, so if we're going to look at this here, so we're going to have SPYs at 680.84 and expiration is 0 DTE. So these are option contracts that expire the same day. So if we're looking to be able to get a strike that is, so here's our ATM. Our ATM is going to be a little bit closer to the price, right? So if we go OTM and our OTM is going to be the 685, we're looking at a spread of 8.7%, right? It cost us $12 to get in, $11 to get out. Our spread is 1%, right? But the spread percentage is that 8%. So that's one thing you have to be taken into account if you're trading 0 DTE, right? So deep 0 DTE traps is option slippage rules. ATM options have the tightest spreads. It's anywhere between 1 and 3%. OTM options have wider spreads, anywhere between 5 and 20%. Deep OTM options have massive spreads, anywhere between 30 and 100%, fam. So it's going to take a lot more for that stock to move and just to make your money back. And as soon as you get into the trade, you're negative. So that's one thing you have to be able to take into account, right? So with these deep OTM options, right, living right here, you're negative as soon as you get into the trade. So you have to move damn near 16%, right? Make your money back and then make your little 8% on top of that for you to be able just to get parity, right? So low volume strikes, avoid them. So let's go ahead and jump into our quiz. We're going to get 3 out of 3. I'm going to put it out there. So options typically have the tightest spreads. Which options typically have the tightest spreads? Is it going to be deep OTM lottery tickets? We just talked about why it's not, because they have wider spreads. Is it ATM options with high volume? Now ATM are closer to the strike price or the stock price, right? So if it's ATM is closer to the stock price and with higher volume, and that spread is already tight, so that's maybe something. Is it going to be far dated low volume options? So far dated, you let me know that there's time, but what kind of invalidated it is this low volume, right? So with our answer, I've deduced it to be able to be B. Look at that. We started off well. Let's see if we can keep this going. So a 0.05 option has a 0.01, 0.02 bid ask, right? What is the spread cost? All right. I'm breaking out my calculator, bro. All right. I'm breaking out my calculator, bro. Give me 1 second. Let me get my calculator and we can be able to do our spread cost analysis. Just real quick. So an option cost $5 and then it has a bid ask right? And what is the spread cost? So the spread cost is going to be the difference between the bid and the ask. So let's go ahead and get the spread. Then the one time the printer wanted to update is now. So if y'all hear this, I am completely sorry. I apologize, bruv. So our spread is going to be, damn, bruv. So 0.01 divided by 0.05, right? Oh, I see. Y 0.01 divided by the mid 0.015. And so the spread, but you didn't give me the mid. How you expect me to calculate that, but you didn't give me the mid? All right, I need to update that. Don't worry. So this question, I feel like, okay, I'm not going to argue about that. You buy 10 contracts with a 0.05 spread. What is the slippage cost? So we buy 10 contracts, right? And each contract caught with the spread, right? Because you get in, you're paying 50 cents, right? So every time you get in, it's going to be, what is your slippage cost? So you get in, you're paying 0.05, right? You get out, you're paying 0.05. Oh, 10 contracts. So 10 contracts equals 100 shares. So 100 shares times 0.05. So 100 times 0.5 equals 50, right? And then 50 times 10 equals 500. So correct answer is C. Each contract equals 100 shares, and we're going to do 0.05 times 100, then multiply it by 10 equals $500 just in slippage just to enter, right? Now, see, this is better. I can deduce that, bruv. But this, you need to let me know what the mid price was. All right. Answer that. Go back to the other day. All right, lesson 5, and when slippage explodes. This is another one for us to be able to pay proper attention to, right? So volatility spikes is when the price swings wildly. Spreads widen during chaos. Market open, spreads are the wildest. Slippage is the worst here, right? So maybe you want to avoid maybe selling at market open, but again, slippage is going to take away from your P&L. And then we have news events. These news events could be the Fed, and this Fed decides when the interest rates, the monetary policies, right? So how much does it cost for the banks to be able to borrow money? So if it costs a lot of money for the banks to borrow money, they're going to offset that to the individual companies, to the individual investors, right? So if the interest rate is high, right? So if they're dovish on the environment, right, we're going to be able to see companies that not perform as well. But if we're hawkish on the environment, we're going to see companies perform well, right? Because it's a lot cheaper. You want to be able to stimulate the economy. If you make it cheaper to borrow money, then companies are going to be able to borrow said money, put it in R&D, put it in different parts of their environment, their different parts of their company, so they can be able to grow. So the Fed has a big job here, right? So we have CPI, which is the Consumer Price Index. Then we have earnings, right? Then we have spread explodes, and fields get ugly during these different events. Okay, then we have 0 DTE. 0 DTE in the final hour, last hour before expiration. Spreads are massive. And 0 DTE are option contracts that are expired the same day. So danger zone, slippage isn't a constant. During certain times and events, spreads widen dramatically. Knowing helps you avoid worst contract cost, right? So memory trick, best traders avoid trading when slippage are the fattest or the widest, right? Market open, slippage are 2 to 5 times wider than normal. Price discovery happening, wild swings, wait 30 minutes if possible. Major news events, we have the Fed announcement, CPI or job data, or we have earnings, right? We're going to have the different type of events, sometimes PPI as well. And also, we already talked about the job. Sometimes, but these main different types of events, right, are going to be the major news events that's going to impact slippage. For 0 DTE, is going to be the final hour between 3 and 4. Market makers, wider spread, gamma risk, right? Liquidity dries up. Not that many people are trading it within the last hour. So your spread could be 10 cents, right? Becomes 30 cents just in that final hour. And then low volume time, typically between 12 and 1, like right now. And I'll still consider this low volume time. Pre-market, after hours, and then weekend. Holiday weeks, we're going to see a little bit low volume as well. So spread multiplier by event. Normal trading, 1 time, just baseline. Market open, you're going to have 2 to 3 times. Fed announcement, 3 to 5 times. CPI release, 2 to 4 times. Earnings for options is going to be 3 to 10 times. 0 DTE final hour, 2 to 5 times. And then a flash crash, and that does happen, 10 to 50 times, right? When to trade, from 10 a.m. to 11:30, morning sweet hour, right? Sweet spot. You're not going to pay that much in slippage. You're still going to pay your slippage, but it's going to be your baseline. Sometimes it can crash. Sometimes you will see a little flash crash there, right? But normally you're going to be at that 1x, right? 1:30 to 3 afternoon sweet spot. But again, it's depending on how you trade your strategy. You want to be right before, right after that lunch, little lunch sell off, and right before the final hour. No major news events that day. High volume liquid products like SPY, top 500 companies, QQQ, top 100 tech companies, or Apple. And Apple is in both of these, so that's kind of funny. ATM or near ATM strikes for options. A real example, Fed day slippage. A normal SPY option spread was 0.3. A Fed day announcement, it jumped all the way, damn near 5 times, right, to 0.15. Your 50 contracts on a normal day would cost $150 in slippage, right, to buy 50 contracts. But on a Fed day, it costs $750, bro. $600 extra dollars just because of timing. So keep this in mind, fam. If you don't learn anything else, to being able to understand how slippage impacts our trading. When spreads are typically the widest, right? 9:30 market opens. So I'm going to just double check this because I want to get 100%. 100%. So when our spreads typically the widest, we have earnings, then we have a flash crash, market open, right, 2 to 3 times. So let's see what our 10:30 a.m. a normal Tuesday. That's funny, not the widest. 9:30 a.m. on a Fed day. Yep. So you have 2 things that are compounding, right? You have the market open and you have a Fed day, right? So that's going to be crazy. 2 p.m. on a quiet afternoon. So we're going to have B. Beautiful. Double danger. It's 3:45 on a 0 DTE expiration day, right? 0 DTE are option contracts that expire the same day. Spreads are likely tighter than normal. Everybody wants to trade. The last 15 minutes of the market, same as always. Or is it going to be much wider? Market makers protecting themselves, right? Why? The final hour is going crazy. You want to be able to, they want to protect themselves, right? So it's going to be a lot more costly to be able to get in. Best time to trade for low slippage, right at 9:30 to catch the action. Is it worth it though? Because it's going to cost you to catch that action. Or is it going to be 10 to 11:30 after things settle? I think I heard that before. Or is it going to be 3:30 p.m. to catch the end of day moves, right? So it is going to be a 3. Look at that, 3 out of 3, fam. Yeah, what's up? So lesson 6 is going to be our slippage simulator, right? So this is where we're going to be our last lesson for the day. So just to be able to understand how this works a little bit more, and we also created a simulator so you can see that, right? So formula is going to be to estimate how much slippage you'll pay. A round trip is going to be the buy, and when you're buying, if you want to get into the market, what are you paying, right? You're paying the ask price. If you want to get into the market, if you want to get out of the market, you are paying the bid price, right? So you pay slippage twice, both on the buy and on the ask. So execution cost is going to be the total cost to enter or exit the trade, and that is going to be the slippage, and is going to be your commission cost. So break even is going to be the price where you don't lose or you make money after the cost. So the simulator lets us use a real tool to estimate slippage before you trade. The simulator uses live market data to show true cost. Always know your cost before you click the buy button, right? Excuse me, I didn't want to cough in your ear. So SPY is at 1,000. This is a market order. And remember, market orders have one of the highest slippage. So the bid price is when you want to get out of the market. The ask price is when you want to get into the market. So if we want to buy 1,000 shares of SPY, we're going to be paying the ask price. And this is going to be our spread. And this is going to be our mid price, right? So estimated fill is going to be the 680.19, right? Because we're going to get into the market. We're going to, if we want to get out of the market, is going to be the 680 18. So slippage cost is going to be entry $5, exit is going to be $5, round trip is going to be $10, just for in order for us to trade this particular contract. Now let's talk about the options, right? Simulating 10 contracts of SPY at the money calls, right? So contracts, we're buying 10,000 shares, 10,000 ownership shares, right, of SPY of at the money, so near the current price. And calls, we're betting that the market goes up. So the underlying stock price is 680.19. We're buying a call at 680, so super close to that underlying price. We're buying 0 DTE. 0 DTE are option contracts that expire the same day, and we're buying 10 contracts, right? So bid is if we want to get out of the market. Ask if we want to get into the market. Our spread is going to be the difference between the two, which is 1 penny, or 0.60, which is the spread percentage. Our volume for this particular strike price is 152,000 people, and 152,729,000 people are trading this particular 680 call contract. And open interest, we have 2,900 people that's actually holding it, right? That's actually trading that position currently. So the slippage cost just on entry is 5, exit is 5, round trip is $10 per contract, right? It's $1 per contract. We're buying 10 contracts. So liquidity comparison. So comparing across different products, we have SPY, super tight spread, but super tight spread, then spread interest, and then the lowest is going to be the best, and then we have ARC, right? Spread is tight, but the spread percentage is a little bit higher because they're a little bit small cap company, a little bit more risky in order to trade them, right? So we were able to go through and understand how slippage works and how we can be able to calculate it ourselves, right? So one thing I want us to be able to keep in mind is work this into your algos, right? Because that's one thing that's been kind of hampering at me, right? Because I've been running our bots for quite some time now, and I was like, yo, why isn't this P&L working the way I need to? Because I've been forgetting to include the slippage, right? So it's been something that's been benefiting me. I hope this is something that's benefited you. If you do have more questions, don't be afraid to drop that off in the comment. It is your boy Kreative. I'll be back at it again with another episode.